Krishna Kumar joins us. He joins us live from Singapore, Director Eastspring Investments. KK, fantastic to have you back. Thank you for joining us.
Pleasure. Thank you very much for having me.
Are you a bit surprised with the kind of force Indian markets have exhibited between September and now? End of September and now, we are up a good solid 10% on the Nifty and about 10% plus on the Bank Nifty. The economy or the economic indicators are at a record low and benchmark indices are at a record high. So who will get it right, the economist or fund managers?
The fund managers have been getting it wrong, so the fact is it is a bit of a conundrum to kind of see the way the markets are. But the fact is, let truth be told, that the economy obviously is struggling a bit, and there are several parameters which are not pointing in the right direction. So we will see how this plays out. But the fact is that there is ample liquidity. There is a bit of a, Santa Claus chase which is happening. And these things kind of happen. Markets can remain irrational for a fairly long time. And I guess there is, people are looking for investment opportunities and hence buying equities. So I presume that it can be the way it is for much longer.
Invest in this market. Where there is growth, there is no value. Where there is value, there is no growth. You have a compulsion to invest because your clients are telling you that, look, we are getting money at 2%, give us better options to invest. So is an old-timer like you, who has always been, who always values growth and quality of businesses at a reasonable price, now in a bit of a dilemma?
No, it's a constant challenge, right? The entire business of investing is obviously, and making money is a difficult proposition. Sometimes it's easy, sometimes it's not. But on a longer term basis, if you remain rational and kind of be sensible and exit the names that you don't think are offering enough value, and you have to preserve capital at the end of the day. And some bits you've got to leave on the table and walk away. I mean, the markets are getting rather irrational at pockets where we don't want to be. So we will walk away saying that it's okay to kind of not be in this game and possibly sit out, or maybe, there are pockets of value which is emerging in the form of maybe utilities or other spaces where you will kind of hang in there and make money. But it is definitely important to kind of stay away from names which are which will obviously offer less value going forward and are very prone to accidents.
So, KK, morning. Firstly, the next obvious question is going to be, when do you think this irrational exuberance which is currently playing in the market is going to end? You said this is going to last for some more time. By then, do you sense the economic recovery will kick in and thereby the markets would remain where they are? Or do you think at some point the markets will align themselves with the economics which is prevalent now and thereby we'll see that correction play out?
So it's a good question. I don't know the answer for that, when it will play out. But the way I think about it is as follows. If the liquidity is going to be the way it is and the current availability of funds and lack of opportunity for investing continues, it can be there for much longer. But there will be a situation where obviously the economics and the markets will converge. And the fact is there are negative surprises which are getting digested very quickly. So the fact is, it's certainly a matter of time that, we'll have to wait and watch. I'm assuming that, the fact that economic scenarios the numbers that we have are obviously not supporting the way the markets are today. It could be a time, it could be a while before, these things play out. And, my concern is more in terms of it shouldn't end up in an accident, which is what I'm more worried about.
So in that meantime, when the market or the economics, whichever comes first, plays out its true color, or for that matter, the both align, what should investors do? Buy more of the same, those same 10 stocks which have held the market up? Or is this the time to really homework and hunt in the beaten down spaces wherein there could be scope of higher alpha generation?
Yeah, that's correct. I mean, so the market is getting narrow. It's just not India. It's also multiple other markets, including US also. The markets have become very narrow. And a few stocks are holding up the markets and basically taking it to new highs. So there is a fairly large bit which is neglected and it's getting ignored, and we see pockets of those. So we are rotating around names where possibly there is, there is a lot of fear, and it's gripped the system, and people are gravitating away from the excessive fear space to the greed space, which is kind of becoming a very stark. So it is time to go out and say that, listen, I want to kind of be away from the fashionable stroke well-done names and move away to, names or sectors where you will see pockets of opportunity when there is excessive pessimism, which is very apparent, and the markets are very polarized. So there is opportunity available there.
Spell it out for us.
I love to, but the way I think about it is, the NBFC space is a classic. I remember when I was, I think, with you guys about a year back, I told that I'm not away. I'm not sitting in the NBFC space at all, and now that the irrational whatever bit is completely blown up. So the fact that today it is now sitting on the other end of the pole, where we think that some pockets of value still, exist, and there is excessive pessimism and doomsday forecasts which are going around, where we think that there is opportunity. I also believe that there's a 5-year massive erosion in value in the pharma space, and it's kind of very fashionable to be shunned and ignored, if I may. The valuations look attractive, and we're beginning to kind of see pockets of value emerging there. I also think that it's a great time to kind of think about utilities as rates kind of do whatever they do. It's a very unfashionable space, but money is made in spots where there is not too much crowd.
Then would India still feature as, let's say a little bit more of a priority amongst the current global context, since you are seeing these pockets of opportunity even at current levels? Does that mean that there is more money willing to come in and bet on those opportunities and ideas moving forward?
Yeah, there is, the way people think about it, when you look at the aggregates, when you look at the ROE erosion in the market, stroke, the earnings disappointment for the last 7 years, it kind of shuns people away, or people kind of look away because the aggregates do not reflect the right pointers. But the way we think about it is, India is a bottom-up play. India is a country where there is a excessive swing between greed and fear, and people gravitate towards more fashionable, which other markets also do, but India does it more stark. And so we think that money will find opportunities, and whenever there are, we will kind of allocate more. And currently, we are evaluating. So it's not a top-down function for us; it's more of a bottom-up in terms of opportunities available.
Whereas it's important to also, while it's important to be a top-down, investor in India, we cannot ignore the importance of mean reversion. Now, there are a lot of sectors which have given great CAGR returns in this decade. Private banks, select consumer names. Insurance has been a standout gainer. Do you think as we roll over from this decade to the next decade, for next 3-5 years, do you think the same set of compounders will give market-beating returns?
They could be. I mean, I suspect that the reversion to mean is a very important aspect that one needs to focus on. And India is an under-penetrated market. I mean, as more people fall out of the system, there could be some sectors which will see massive penetration and increased reach, which will deepen the market. And it is a function that its opportunities are enormous. And the markets are getting a little more concentrated in terms of number of players. You could see that in multiple sectors. And as the players get more concentrated, they get pricing power, and they will increase depth and increase share. So the secular bits can sustain and stay secular for a fairly long time.
Like utilities, because utilities, they tend to do well when there is a decline in interest rates. I mean, that's the time when the power grids and the NTPCs of the world will outperform. RBI has shied away from a rate cut. So if indeed we are nearing the end of a rate cut cycle, what is the underlying thought behind buying utilities?
So the simple answer is it is sustainable long-term returns that you're looking for. Rate cut is you're right. I mean, intuitively, that is the right thing to say, that when there is rate cut or when there is a softer rate regime, that you will see utilities doing well. They have not done well when the rate cuts have, for the last 3 quarters that we have seen rate cuts, the utilities have actually gone down, contrary to our intuitive thought that utilities should do well. But you must understand that these are high dividend yield companies. These are paying out annuity incomes, and they are underappreciated. They're trading at historic lows, and it's a completely it's a unfashionable space to be. And so that catch up will have to happen, that people will realize that cash streams are more important than just buying companies at 9 times book.
My next follow-up question would be on what, to your mind, could be the next pool of profit opportunity. And let me rephrase this one. You will understand it, but just as for the benefit of our viewers. In 1980s, cement did well. Then we had a boom in IT. Then we had a boom in infra, followed by a boom in NBFCs and to a large extent consumer names. So you've understood the essence of my question, KK. So should I ask you a question or you would like to answer it?
Nikunj, I hope it's not a trick question. But the way I think about it is we're still kind of focused on names where there is opportunity. Pharma is one space where I think you could get surprised. I also feel that general insurance and insurance remain massive opportunities. General insurance is a good space to think about. They're not very cheap, but the point is it's a secular play where penetration levels are really low at about sub 1%. And the market is maturing and people are understanding the need for general insurance, which is P&C business. And globally, P&C acceptance with a population base of whatever we have has only grown over time as people realize the importance of general insurance. So my guess is, the themes will be more on the protection side, essentially, which will mean that you will possibly see pharma as an opportunity, which is very fashionable, and I will be very unfashionable to tell you this, that there is a opportunity in secular which can be inflecting soon.
A lot of chatter around what the government can do and should do to try and revive the economy. And, within that, the next big event, of course, is the budget in February. And there's a lot of chatter that perhaps personal income taxes are going to be lowered. What would you, as an India observer and investor sitting outside the country, want to hear from the government at this point in time? And do you really think the government can alone really do the task of heavy lifting the economy?
So we are in a spot. Budget is obviously a very overrated event. But think about it differently. That today we have a scenario in the last 3 years. We have seen corporate ROEs have eroded. Corporate debt levels have gone to reasonably, higher levels than history, which is about close to net debt to EBITDA is about maybe 3.5, which is very high. Given that you're seeing a slowdown in power and generation, in mining, in freight. So there are two parts to it. First part is obviously your corporate tax rate cut is good, but not enough. Your private, your individual tax rate cut could be good, but may not be enough. What is most important in my view is business sentiment. If the business sentiment is not good enough, you can try whatever trick you want on the book, but it will not work. So according to me, or the way we think about it is, you need to get private capex back in the system. Private capex will bring back job creation, which will bring back little surplus in their hands. You're not going to tax people when they don't have money, right? I mean, you need money to kind of tax people. And it's important to kind of get the private capex and sentiment back in the game so that you will possibly kind of revive the economy first before you can get into the taxation game.
Because the government did intend and they did cut the corporate taxes. Even then, there hasn't been any private capex revival.
So that was the idea, that the point of cutting corporate tax was to increase corporate savings, and corporate savings comes back as capex. But in an uncertain world or in an uncertain policy environment, it is very difficult. People will start hoarding cash and not put it back on the ground or not even pass it on to the consumer. So you need to kind of create the business sentiment, which will kind of help them put the money back on the ground. So corporate savings is not essentially that, driver, maybe what they would have done or could have done is to boost investment stroke consumption sentiment to kind of push, because the system is totally underutilized. There is enormous operating leverage which is there in the system, which should be possibly kind of in the forefront of thought. But I did not see that. Corporate tax rate is fashionable, it's good press, but it's not necessarily enough to translate to corporate capex.
I'm going to go back to the essence of our first question, which is that the economic recovery has not happened. I hope it happens, but let's talk about a scenario when the economic recovery does not happen. So what happens to India? Are we likely to see a scenario where consumption will continue to boost that little bit of incremental growth and savings, it will continue to drop down? If that is the scenario we are looking at, then how does one invest in a market?
So, Nikunj, hope is not a strategy. We hope that economy recovers. We hope, but all that is fine. We need to do something to make it happen, or there has to be, enough pointers to make it happen. We do not see enough of those. In which case, it is reasonable to assume that you need to move away from high value stroke expensive names and be more defensive and be in utilities. That's the reason why I said that. It is widely perceived that economic recovery market normally leads in economic recovery. But in my view, it's possibly maybe not the case. Or if the economic recovery is about 2 quarters away, then the market is leading it. I'm not able to read it very well.
And again, I'm throwing these scenarios at you, KK, because that's what ultimately we'll have to consider. Another scenario is that we could remain in a scenario of low growth for long at a global level, which means interest rates remain low. I don't want to use the word permanently, but for a long period of time, the arbitrage continues in a market like India, and a lot of money will chase few stocks. So are we in that last hurrah? Are we about to reach the last hurrah when we will actually read blowout levels for a Bajaj Finance, a DMart, a Nestle? Are we there yet, or you think that climax is yet to happen?
So you're right. Just 2 days back, we cut back on long-term growth assumptions for developed in Asia and also India, China. Long-term growth numbers we have kind of pared down by about 50 basis points, which essentially suggests that this could be lower for longer. Lower for longer and a loose monetary environment can create asset bubbles, which we're probably seeing already. How will that kind of shape up at the end? Maybe there will be corrections which can happen as we go along when the reversals of rates happen. Having said that, I'm not a doomsday guy. I'm not saying that the world will come to an end. We'll all be searching for our wallets and we will have nothing to kind of do after about 2-3 years. The fact remains, I think this will all kind of settle down, and maybe growth is not as elusive as, or we'll settle to a new normal. The asset prices will have to settle to a new normal or settle down to more sensible levels. Whether it happens in a flash or whether it happens over a period of time is what we have to evaluate. But I'm not a doomsday guy where I think that it's all coming to an end. There is no volatility in any market, for example. Low growth, high valuations is a function of liquidity.
What we've seen, KK, is that post the trade war, emerging markets have underperformed, developed markets have done exceedingly well. It's normal to assume why that's happened, because emerging markets will take a greater hit because of trade war. What if trade war intensifies? Are we in for longer period of emerging market underperformance?
So, I have now managed a China fund for almost about 10 years, and I have little insight in terms of how the trade war seems to be panning out. So the trade war is a permanent scenario. It looks like it will take different forms and shapes, milder and harder, but the fact is that the trade war or the trade restrictions stroke tariffs will remain in some form or the other. It's a new normal. Let's accept that. If that be the case, there will be adjustments either in the form of migration of manufacturing into other markets, or it will also be adjusted with currency movements. Once that is done, I think that will be the new normal, and things will kind of just carry on the way it is. The developed market can possibly, it's also a function of liquidity. It's a very narrow market, and there are 5 stocks which have contributed to 97% of S&P, for example, which is dramatic. But having said that, the growth numbers which we have moderated will be valid for all markets in the emerging space, and you will settle to a new way of thinking about the markets and valuations. In a situation where liquidity is ample, the trade war is known, or it's kind of the new normal, the whole thing will settle down. I mean, it's not, you can't believe that this is a war which is going to kind of intensify, which will kind of break countries or economies. They will muddle through this and will accept it as a new normal.
Just wondering, KK, whether or not one needs to worry about any global level accident at this point in time. A lot of developments. You've got the US elections, or rather UK elections, as well as the US elections too. We've already heard from the Fed last night that they're going to be in pause mode in 2020. And I ask because, that's going to have a bigger damage for India, because part of the reason that India has been managed to hold through is also because US equity markets are doing well.
I don't know whether US has a fantastic bearing or great bearing on Indian markets. Honestly, I think the correlation is very poor. S&P and India is not correlated, very marginally correlated, or not at all. But it is good to be worried all the time. A worried investor always stays alert. When you kind of think about whether there is a global accident in the offing, I cannot see one. The rates are benign. The rates possibly will see a pause, which will possibly kind of unwind some of the carries which are going around in the world. India has seen some flows, but not spectacular. But the arbitrage will kind of play out in a way that if the gap between US rates and Indian rates are going to stay the way they are, or they kind of widen a bit, given that India is also not cutting, you have also US sitting wherever they are, the rates, the spreads will remain quite stable. That will possibly see flows, and there will be cross-border movements. But I don't see an accident per se, honestly. India looks a little more vulnerable from the perch that I am sitting in, because there is serious issues of ROEs being lower than cost of capital. And on a sustained basis, if ROEs stay below cost of capital, you become more vulnerable because you're destroying value. The government borrowing today is significantly higher than the GDP growth numbers, which is again destruction of value. If you keep destroying value and you kind of have multiples which are not sustainable, that makes it a little more dangerous. And but on a global basis, I don't think there is. I can't see one which is going to. Earnings vulnerability is obviously something which is to be watched out, and if there is not enough support from the earnings side, maybe there is a concern.
All right, KK, appreciate your time. Thank you for joining us, and hope to see much more of you going forward.
Pleasure. Thank you very much for having me.